Why your business value matters. Just to go over a few things first, we are not attorneys nor practicing CPAs, and we encourage that you consult your legal and accounting professionals to determine whether any ideas presented here today would be suitable for your company. So you've worked hard to build the value of your business, and chances are you've thought about when you want to sell it, who you want to sell it to, and for how much. You might also be depending on your business for retirement income. So you want to make sure that you get the full value when the time is right. Now, how can you do that? That's what we're going to cover here today. The 4 key components are knowing the value of your business, having a current succession plan in place, protecting the value of your business from planned and unplanned events, and building a secure retirement for you and your key employees. Knowing and protecting the value of your business can impact your future in many ways. The value is an important consideration for your future planned events, such as transition planning or retirement. But it's also important to ensure that value is protected for the planned and unplanned events that may come up. So let's talk about how you can go about determining and enhancing your business value. If you aren't sure what your business value is, don't feel bad. As you can see, you're not alone. 58% of business owners have never had their business valued. And of those who have had their business valued, a little over half, or 56%, have had a valuation done within the last 2 years. And the remaining have had one done in the last 2 to 10 years. So how exactly is a business valued? There are many different methods, and no one method is right for everyone. Depending on the purpose of the valuation being done, ultimately, fair market value is the amount agreed upon by a willing buyer and a willing seller. But we realize most business owners won't seek a market value until they're very close to selling their business. However, long before you prepare for that, there are several reasons you need to understand the value of your business for protection purposes. So let's take a look at some of the factors that come into play when determining the value of your business. What factors impact your business value? There are several factors, actually, and we can look at Revenue Ruling 5960 to provide guidance on considerations that may impact a business's value. Things such as the nature and history of your business, the outlook of economy and specific industry that you're in, financial condition of the business and its book value, earnings capacity of the company, nature and value of any intangible assets of the business, such as goodwill, relative size and block of business interest to be valued, and any prior sales, and the market price of actively traded stock of corporations in the same or similar business. As I noted earlier, there are a number of methods and formulas that can be used to determine your business value, depending on the purpose of the valuation. The type of business you have also comes into play. Is it asset heavy or more service and consulting based? These methods serve only as a guide to owners. No single method will work in every case. The following are some established and accepted legal and accounting methods to value a business. The first is adjusted book value. This is where you take the assets with adjustments, less your liabilities. And this is typically used to represent what would be the liquidation value of a business. Formulas, which can include the capitalization of earnings. Method, it looks at the capital that would have been invested at a specific rate to yield the current average net annual earnings of the business. This is typically appropriate more for like a consulting type company or those with few to no tangible assets. Multiple of discretionary earnings. This is where a company in the goodwill of owners have a significant impact on the value. This results in earnings provided by goodwill times a multiplier. Adjusted book value is then added to this number. This is typically more for like a service-oriented company. Excess of earnings method, which is a combination of adjusted book value and capitalization methods. This type is typically good for manufacturing-based firms or firms with significant actual assets or equipment. And then the discount future cash flows method, which is projected future business earnings forecasted, then discounted using an appropriate rate. This type is generally used more for mergers and acquisitions. The last is comparables and market value. This method is based on the price of a similar or comparable business that's recently sold, and this value will generally be provided to you by appraisal firms. So where can I get business value? You can get various types of valuations from multiple sources, and those valuations can serve many different purposes. Most of the time, the reason for the valuation will determine the best source to perform it. A business appraisal firm will make formal valuations for tax planning purposes, and these can typically cost $10,000 or more. An investment banker or business broker, this is a good option when considering a sale to an outside third party. They provide not only a valuation, but information on market conditions currently. CPAs may provide valuations as well. They may focus on past performance, which can be a very credible benchmark, particularly in the initial stages of exit planning. And then insurance and financial professionals can also perform informal valuations, which can provide provide valuations based on a company's financials to allow you to obtain a range of potential values in order to initiate and necessitate business planning. So you may be wondering, if there are many ways to enhance your business value, how can you do it? These are the things investment bankers and business brokers look for when valuing a business, because it's the same list of attributes that are relevant to investors. Maybe your company is ready to sell tomorrow, but you could likely increase the price by implementing some of the following improvements. A lot of these are common sense. Just step back and look at your business from a potential buyer's standpoint. Work with your attorney and CPA to clean up lingering tax, legal, or accounting issues. Consider obtaining audited financial statements. Review accounting procedures, and review corporate minutes, organizational documents, and other legal documents. This takes little time now, but will usually make it easier to sell your business in the end. Regarding the last item on this list, to build a solid management team and groom a successor, most buyers will want an experienced and capable management team. The value of your business will be lower if you're the only key person, typically. An executive compensation program can attract and retain the right management team or help groom a potential successor. Hiring a business consultant to analyze your business and develop recommendations to increase growth, profitability, and marketability may be worthwhile. Most of these things cannot be accomplished overnight. Exit and succession planning, I'm going to have a problem with that word all day, I know it, is most effective if it's done for the long term. So you want to be thinking about this well before it's time to implement anything. So by keeping all of these things in mind, such as focusing on increasing cash flow, developing operating systems that improve sustainability of cash flows, document sustainability of earnings, improving your facility's appearance, paying down debt, solidify and diversify customer base, and implement a strategy to grow the company, you can run your business so that when you decide you're ready to retire, your business will be ready to. Earlier, I did mention that understanding the exit and succession planning process is useful even if your retirement isn't right around the corner. These recommendations will help all businesses, whether you intend to sell to a third party, transfer to a child or a key employee. Observing these best practices can help increase the chance that you'll have a successful exit transition. If you're not sure where to turn to begin the process of valuing your business, we or Principal can help. Principal offers a complimentary informal business valuation. They use 5 common valuation methods as part of the process. We provide you with customized reports and documents based on the information that you give us. And these will serve as a starting point for discussions with your tax and legal advisors. Are you a candidate for an informal business valuation? Some specific industries that are a good fit for the service that's offered would be things like manufacturing companies, construction businesses, professional service organizations, IT companies, healthcare providers, or any profitable business. While there are types of companies that are more challenging, such as farms, real estate, publicly traded companies, financial service firms, non-for-profit organizations, and a new company, because it's difficult to trend a new company if there's not a history to provide behind it. Also, businesses where a sale is imminent or close to happening. As we discussed, valuations provided aren't intended to establish market value or sales price in this particular process. Before we move on to the next section, I wanted to share an example of the key page from an informal valuation proposal that we provided. As you can see, they provided values based on 5 different methodologies for each proposal: adjusted book value, as well as 4 other values, highlighting the one best suited for the company that was reviewed, based on that company's financials and other information provided. There are several key factors that are impacted by knowing and protecting the right value when it comes to your business. Your estate plan can be impacted with regard to how your heirs might be taxed. Your buy-sell agreement will indicate what value should be considered for various triggering events. Losing or retaining key employees can also impact the value of your business to a potential successor or buyer. And lastly, do you have a ready market for your business? Have you done everything you can to value the plan and your business? The questions from the prior slide identify the next logical point of discussion, which is the need for you to implement and update your succession plan. In the event of your death, disability, loss of a key employee, or future change in management, would your business be as successful as it is today? If the answer is no, you're not alone. And the good news is there's help. Well-crafted and funded business succession plans and/or buy-sell agreements offer protection for a variety of events, many of which you might not see coming. These can include a change in relationship between owners. Like marriages, relationships between owners can fall apart. Why? Some common reasons are they grow apart, they develop separate plans or visions, different strategies or approaches to doing business. One partner is working harder than the other, or it's perceived that way. Or sadly, embezzlement or other unethical or unlawful activities. One owner may die. In this event, your new partner could be the surviving spouse or other family member. An owner becomes disabled. From a purely business perspective, this may be more difficult than a partner's death. And additional events that may make a succession plan important include mergers or acquisitions, divorce, bankruptcy, retirement, or involuntary termination. In addition to challenges that come with not having an agreement, there are additional challenges that can occur if the plan you have in place isn't complete or up to date. Let's take a look at some of those items. If they aren't formalized, this is the most problematic. Some folks believe a handshake agreement should suffice, but trust me, it's best to solidify an agreement and lock in key variables, such as transition scenarios, valuation methodology, and protection mechanisms at the beginning of the relationship rather than having to negotiate with them when emotions are high. And it's essential to have it all in writing. What if the agreements are poorly structured? We've seen agreements that provide no transition strategy for an owner unless the other owner dies or does something illegal. That means that for all the other scenarios or events we described before, the partners have no way out without costly litigation. We also see agreements that have no valuation methodology or use a methodology that wouldn't pass muster with the IRS. It's better to develop an agreement with advisors who deal with these types of agreements on a regular basis. What if there's no funding or only partial funding? If an owner dies or becomes disabled, and there's no funding mechanism that enables the surviving owner or owners to buy out the other, the surviving spouse or family becomes the new partner. The result is that the other owners often find themselves unequal partners with someone who isn't contributing to the company. One business owner came a few months ago because his 72-year-old partner was no longer contributing, but was still drawing 50% of the company's profits. When you look at their business agreement, it had a provision for disability income for partners, but the company hadn't purchased disability income policies for the partners. Just imagine the liability that they could have been facing. It's better to have life insurance and/or disability buyout insurance in place in the beginning to enable owners to make the break and move forward. Also, what happens if they're just outdated? The business succession plan and other buy-sell agreements should be living documents, flexible enough to grow as your business grows. Laws can change, and funding mechanisms need to keep pace with your business's value. It's best to open these documents up periodically to ensure they're keeping pace with your expectations and your intentions. Do you already have a business succession plan and/or buy-sell agreement in place? It's important that you evaluate it and ask the following questions. Have all the possible common problems been addressed? Does your agreement specify what happens in the event that a relationship between owners goes bad? Or if there's a death or disability or any other events that we've talked about previously? Is the method to determine the business's value clear, specific, appropriate, and continuous? If you need help with this, we can provide complimentary buy-sell agreement review services so that you can learn about the best practices and work with your attorney or CPA to ensure that your agreement is going to hold up to every potential scenario. Is a mandatory buyout required upon death or disability? What about retirement? More business owners transition during their lifetime versus at death, so you'll want your agreement to address your intentions at retirement. Is disability defined and consistent between the agreement and the policies funding the agreement? Many times we find the definition of disability to be different in the agreement and in the disability policy, which can create issues, particularly from a timing perspective. So the bottom line, a current and well-funded agreement allows you to have the right amount of money, Is there any funding that is in place, and is it adequate to meet multiple scenarios? To have it in the right place, does the funding source, i.e. an insurance policy or other assets, provide for the right payments to be made to the right person or entity, and are the parameters consistent with the agreement? And at the right time, meaning that the funding and payment terms must be in sync with each other. It all seems pretty straightforward, doesn't it? Well, you'd likely be surprised just how often owners' intentions aren't accurately reflected in their buy-sell agreements. As an effective buy-sell agreement is at the root of a successful business transition plan, best practices suggest these agreements should include at least the top 3 mandatory triggers: death, disability, and retirement. Yet if we look at the percentage of agreements that actually include the top 3 transition events as mandatory buyout events versus optional ones, you can see these triggers are optional buyout events in a significant number of agreements. A good number of agreements that are in place address a buyout at death. Only 71% of those have it as a mandatory buyout event. However, disability and retirement are often overlooked. Planning for these events will help ensure that a successful transition of your business can happen during your lifetime. So far we've discussed the importance of knowing the value of your business, and then how important it is to have a current, well-funded buy-sell agreement in place. So now we're going to take a look at protecting the value of your business. Business protection involves implementing strategies to preserve, protect, and promote the value of your business. Why is this important? Business protection helps you maintain business operations in the event of a loss of an owner or key employee, preserve the value of your business until you choose to exit, and better facilitate a transfer to family members, key employees, other owners, or even third parties when you exit your business. So we just discussed the most of these triggering events from the buy-sell agreement perspective. It's important to protect against all of these events, some of which are planned and some are unplanned. Some planned events might include retirement or termination of a key employee. Unplanned events could be death or disability, divorce, or bankruptcy. So now let's look at some common concerns business owners like you have to think about for your own transition plans. When can I exit my business? Will my children be able to or want to take over? Will it sell for what it's worth? How can I avoid huge taxes? Can it survive without me? And how can I incite key employees and my management team to stay? Incent. Some of these questions may apply to you while others don't. The goal is to let you know that there's a process that can help business owners like you answer the following questions and much more. How do closely held business owners exit their businesses? It's easy to think you'll have plenty of time to prepare for a transition in business ownership, but time can go by faster than you think. And many of these events, both planned and unplanned, could change the business, like retirement, dissolution, death, disability, divorce, and termination. You've worked hard to build your business. Now is the time to protect its future and those who depend on it. There are many succession plan strategies to consider, and we're here to help. So let's start with some simple questions to narrow down your options. Having a well-documented plan is important, but it's also crucial to have a current value reflected in that agreement. This is where things can get tricky because many business owners think the value is something they can set and forget. But depending on the formula and/or the valuation method they outline in their document, it may need to be reviewed as often as annually. Only 4% of the buy-sell agreements that have been reviewed reflect a current fair market value of the business at the time of their review. If there's uncertainty about the company's value, this can result in an unintended negative financial impact to the owners. Putting a well-crafted and fully funded written plan in place, reflecting an agreed-upon fair market value, will allow you to be confident about your exit strategy. Your business will likely play a key role in your retirement, which is yet another reason knowing and protecting the value of your business is so important. Depending on the value of your business, the strength of your buy-sell agreement, and proper funding, your business can generate income during retirement, just like it has during your working years. If you want to gift it to your family and continue working instead of selling your business, that's also possible. All it takes is some careful planning. Some potential retirement income sources that you may have could include Social Security, any qualified plans such as IRAs or previous 401ks or 401ks you set up for yourself during the business. Maybe you have non-qualified plans or other savings and investments. And then, of course, you can consider the sale of your business. All of that will come into play when you try and figure out what it will take to retire for yourself. So how secure will you be during retirement? As we've outlined, knowing your business's value and having a current transition plan are important first steps to figuring out how much you can rely on your business in retirement. You also need to consider how other savings and investments may affect and effectively contribute to your income. Principal offers a business owner's retirement analysis that can pull all of these factors together to help you evaluate your current plans and financial situation. And if needed, it can direct you to strategies that can help you as a business owner achieve retirement readiness. What will it take to generate the retirement income you need? Here's a hypothetical scenario. Make some assumptions, which include that your retirement age is 65, you need income to age 90, you have an annual retirement income need of $225,000, your annual Social Security income is $24,000, your business value is $2.5 million, you have qualified plans and taxable IRAs that add up to $1 million, and you have an investment account balance of $500,000. As you can see from the chart, this would leave you with a retirement gap of $565,958 at age 65. But don't worry, you can bridge that gap if you start planning now. Some of your primary options to do that are to work longer. I know this isn't ideal, but it's always worth considering. You could save more. Consider implementing a non-qualified supplemental retirement plan that may be tax efficient to create additional annual retirement income. Or you could consider activities that will increase the market value of your business. Now let's take a second to think about your staff. Perhaps you're the only person who's critical to the success of your business. But a lot of us have key employee or employees we rely on heavily. What makes someone a key employee? They're the ones who, if they were suddenly gone tomorrow, would have a significant impact on your operations. Perhaps they're vital to getting work done every day. Customer relations. Maybe your key employees often know everyone and everybody knows them, and they don't need a phone to keep track of their contacts. It's all in their head. How about your profitability? They have the direct and substantial impact on your bottom line, which in turn could impact the business value. How about recovery time? If a key employee were to leave, it could take you months or perhaps a year or two to replace them. Maybe you don't have key employees in your organization, but maybe you'd like to. How can you recruit them? The key is to be competitive with what you offer. Offer a competitive compensation and benefits package. You need to compete for good people just as you compete for customers. Someone who's thinking about working for you will compare your package to what's available elsewhere. For example, if you're looking to hire a marketing professional, know that you're likely competing with other companies who aren't even in your industry. That doesn't mean you have to offer the same salary and benefits, but be prepared to offer a competitive package and explain the intangibles that might elevate you above the competition. And consider offering customized benefits. First, there's the well-known perks that you might be able to offer, such as a company car, flex time, etc. But there are other flexible compensation arrangements that are worth examining as well. So let's take a minute to discuss those. To retain top talent and motivate them to continue performing at a high level, it's critical that they love what they do and who they're doing it for, understand how their performance is linked to the future success, and see how their future with the company aligns with their personal goals. So how can you encourage all of these things? One-time cash bonuses are nice, sure, but the best incentives are more significant and ongoing. One solution is key employee benefits. Not only are they great ways to incent your key employees, they're also advantageous to you because they give you a lot of flexibility. There are multiple designs, which means you can choose who you'd like to participate and how much you'd like to spend on that benefit. You can design these plans with the objective to retain top hat or non-top hat employees, obtain current tax deduction for the company, or obtain a current tax deferral for key employees. There are a variety of plan designs and financing options available for plans such as this. Whichever approach you choose, offering a reward that is significant both today and in the future will go a long way towards helping keep you different and keep your top people happy, which means that they will stick around. So wrapping everything up, we know how hard you've worked to build your business. And when the time comes for you to sell your business, we hope that the tips provided to you today get the most value out of it. Again, the 4 keys to doing this are to know the value of your business, to implement or update a succession plan, to protect the value of your business from planned and unplanned events, and to build a secure retirement for you and your key employees. I want to thank everybody for joining us today for the presentation.
Yeah, thanks for everyone for joining on. This is something that we do monthly, both towards business owners here locally, but also as consumer seminars there as well on a monthly basis. So if you found benefit from listening and learning a little bit more about business succession plans, we invite you to invite your partners and other friendly business owners that to help get better educated. So yeah, thank you again for everyone joining. And if any questions do come up there in the future, you can reach out to Chris Franklin here on our team or myself, and we'll be able to help you answer them.